Okie dokie. So mentorship day one, bootcamp day one for what's the month? August. Okay. So we will be going through, right? We will be going through on day one. We will be going through number one, ICT PD arrays, how I interpret them. Number two, external better give credit to ICT external, ICT external to internal range liquidity. Then number three, we have hierarchy of reactions, which is essentially the PD array matrix. So hierarchy of reactions, PD array matrix. Number four, we have refining points of interest. And finally, we have stop hunts, which is what? Price signature that indicates a range expansion or range creation. Okay, that's what we are going to be going through today. Right now, let me take out my trade. It's not going to work out, so close it at a small loss. ICT PDA is ICT external to internal is liquidity, hierarchy of reactions, refining points of interest, and stop hunts. Okay, now obviously everyone is already familiar with everything, but just for the sake of it, let's go through it. Just for the sake of it, right? So we know what ICT PD arrays are as explained by ICT on his YouTube and in his mentorship content, right? So I'm pretty sure to every one of you guys, his mentorship content is nothing new. I'm pretty sure 90% of you have watched his league content already. So it is what it is, right? We know it. We know it. So when we look at ICT PD arrays, right, we know order blocks, we know breakup blocks, mitigation blocks, and all of that, right? Now the question that you should ask yourself is, okay, now when are we supposed to use it? When is an order block highly probable? When is a breakup block highly probable? When is a mitigation block highly probable? Right. So to answer that question, right, number one, we need to have narrative. Okay, narrative. Now, what does narrative mean? Narrative means that if you take into account something like this from day before yesterday, we saw that price came from an unmitigated 4-hour bullish order block. That does what? That switches, right? When we see a move like this, right, it means that it switches order flow. We move from bearish order flow to bullish order flow. Okay, we move from bearish order flow to bullish order flow. So that is ICT 101, understanding order flow, and that is what understanding PD arrays accomplishes. If you understand PD arrays, you understand what the current order flow is, obviously. Okay, so looking at this unmitigated, which is now mitigated 4-hour order block, we know that when we see this reaction that we got over here, we know that it was what? It was a switch in order flow. Now, in switching order flow, what does that mean? It means that once we have gone from bearish, let me just denote it by arrow, from bearish to bullish, the PD arrays that are going to work are predominantly what? The bullish PD arrays, right? Bullish PD arrays. And these are the PD arrays that are going to work when you what? When you see a switch in order flow. When we are in bullish order flow, what's going to work? Bullish PD arrays. When we are in bearish order flow, what's going to work? Bearish PD arrays. Which is why if you zoom out, you can see that throughout the past from Monday we had bearish order flow. Why? Because price was drawn to something. What was it drawn to? This order block. So see, price dropped. See where it wicks into? Wicks into this down close candle, or you can also say this down close candle, which is a breaker. See a breaker block. price drop. So it touches the breaker block and then it moves lower. There you see price forming what here? Bearish order block, bearish order block. This is a what? A propulsion block. Now propulsion block is a bearish order block whose high or body goes into a previous bearish order block. Okay, I'm pretty sure you guys understand, but if you don't understand, just send a message on the chat box, right? So this is a propulsion block. So when price comes into a bearish PD array, which is a propulsion block, here, what does it do? It sells off. And it sells off until where? Until this bullish order block. Then you get consolidation and then you get an expansion. Okay, now that is essentially a PD array. A PD array, we can draw them out as follows. Mitigation block, breaker blocks, okay, breaker blocks, liquidity voids, ICT calls it CB, and then you have fair value gaps. Then you have order blocks. After an order block, what do you have? Rejection block. After rejection block, you have hold high, low. Okay, this is how the PD array matrix works. Now see, we know what an ICT PD array is, and now we are looking at the hierarchy in which they work. Mitigation block, breaker block, liquidity voids, fair value gaps, order blocks, rejection block, and hold high, low. Okay. Now for those that are not familiar with these ideas or these concepts, right? These individual concepts, right? Listen, look closely. When you see a mitigation block, okay, I'll give you both the bullish and bearish examples. When you look at a mitigation block is a price taken into account a bearish example, when price makes a high, lower high, and drops. Okay, this here is the point in which it becomes a mitigation block. All right, this here is the point in which this becomes a mitigation block. So you would reasonably expect for price to come back here and then sell off. All right, the price to come back here and sell off. So this is the point in which you sell. You keep your stop loss here and your take profit wherever the low resistance liquidity is. Yes, it's recorded. Okay, wherever the low resistance liquidity is, right? So that's the bearish example. So when we look at a bullish example of an ICT mitigation block, we know that it looks essentially the opposite, right? We have the low, higher low, and price breaks higher. Okay, price breaks higher. So where's your entry? Your entry is somewhere here. Okay, when price breaks higher like this here is your bullish mitigation block. Your stop loss is here and your take profit is at a point where it's comfortable for you, but it should be a logical point in which profit should be taken, right? It should be a logical point in which profit should be taken. So that is a mitigation block, right? So it's more of a, how can I put this? It's more of a understanding. Okay, it's more of an understanding of how it looks like, how the liquidity has formed. Okay, now remember, it's not pattern. It's not a pattern. It's not a pattern. It's an understanding of how liquidity has formed. There's a reason for price to sell off, right? There's a reason for price to sell off. A breaker, which I'm going to talk about now, a breaker and a mitigation block, they serve two different purposes. Okay, they serve two different purposes. So the mitigation blocks, right, they serve as a continuation. Okay, they serve as a continuation to go somewhere, whereas a breaker block serves as a point of reversal. Okay, a breaker block serves as a point of reversal most of the time, right? Obviously it's not going to be a reversal on the lower time frame, but when you see it on the higher time frame, it shows a point of reversal. But since we're intraday traders, we can also look at it as a point of reversal from an intraday perspective. Okay, so that is a mitigation block. So mitigation block. If you see me, if you see me place an MB on my chart, it means it's a mitigation block. Okay. So if you look at any mitigation block that has happened on Euro USD on the 1 hour chart, right? You can't see it, right? All you can see are what breakers. See, we have a breaker here, price respects it and goes lower. You have a breaker here, break over here, but there is no significant low that it broke, right? So this is not a valid breaker. Then you have a high, higher high, break. This is your breaker, which worked out for about, I think this was yesterday's sell. So somewhere, which worked about 12 pips, 10 to 12 pips. So that's more than enough. Okay, so when you understand how it should be formed, you can easily capture trades like that. All right. So a mitigation block is that. Then when we go and look at a breaker block, right? We understand that a mitigation block is what? Something that serves as a point of continuation. Okay, it's something that serves as a point of continuation. This is high was a H1 breaker too. This is high. This is Friday, this is Thursday, this is Wednesday. Wednesday is here. Yeah, it's a breaker. Yes. Okay, so that. All right, so when we look at a mitigation block, we understand that it's just mainly used as a point of continuation. Okay, whereas a breaker block is used as a point of reversal. See, if you now let's look at how it looks like first. So a breaker block, look at the bearish example, you have a high, higher high, and then a break, right? So this here, this down close candle over here is your breaker block. Keep your stop somewhere here, take profit wherever you want it to be. Okay. Then a bullish breaker block is a low, low, and price goes higher. Stops here, and your take profit is wherever you want it to be. So let me call this SL. SL. Okay. So like I said, these are points of reversal. It's a point of reversal. And now, if I draw something for you, right over here, now let's take a look at this example. Okay, so we have a consolidation. Price drops, boom, and now it does this. So what does this look like? Anyone? What does this look like? Yes, market maker buy model, right? So what that essentially means is, here is your point of reversal. Here is how you can get in on that reversal using a breaker. Okay. Now on Sunday, this will be what we call an institutional swing point, which is a much easier way to understand things. Okay. So the institutional swing point is an understanding of liquidity. This over here, today's portion is just going to be an understanding of how these things work, what they are meant to be used as. Okay. So this is a bullish breaker in which price uses to serve as a point of reversal to go higher. Then if you look at another example, now you know what a bullish breaker is. Now let's look at a bearish breaker. So a bearish breaker is something that looks like this. We have a high, higher high, break, low. The down close candle here is your breaker, meaning that price is gonna boom, go lower. Now the question is, what's the context, right? What's the context? The context is this. Even for a bullish breaker, this move down is obviously going into a PD array, right? Obviously. When you know that it goes into a PD array, boom, there's your context. The breaker is definitely going to work and price is going to go up, right? That's how we can understand. That's how these things work. They work under context, not just, okay? So here you go. We have a low and here's a stop hunt down into the unmitigated order block. Boom, goes up. And then see the next day, the breaker works. Meaning what? Market maker, buy model. Here's your move up. Here's your low risk buy, and here's your another buy maybe, which we took today, and off it goes to take out the consolidation high here, or buy side liquidity at the point of consolidation. Okay, so essentially, what does that mean? The moment price came here, it essentially served as a point of reversal to go higher. Okay, so now looking at a bearish breaker. That's my thing. Okay. If you look at this now, that's not that nice. Here you go, up, 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 one more time, and now down we go. Yeah, down we go. Here's your breaker. Here is your entry. Here is your stop. Quality tester. So then what does this look like? Someone, anyone? Remember some, yes. Okay, so market maker sell model. So what does that mean? This means that the breaker was used as a point of reversal. Right? Breaker was used as a point of reversal. Now, every breaker that you see, okay, if you dive down to the lower time frame, sorry, it's a what? Now, what does this look like? What does this? What does these guys look like? Someone care to say something? Yes, BSR, SSR, meaning what? This is your dealing range. So when a breaker is formed, right? When a breaker is formed, what is it doing? What is this point here with regard to this high and this low? Premium, right? What's this point over here with regard to this high and this low? Discount. So price comes to discount and boom, goes higher. Price goes back to premium and boom, goes lower. See? All right. So we'll talk about that later. Then are the external star market by one? Yes, you are right. Because breakers are order blocks. Okay, breakers are order blocks, and that's how it is. Breakers are order blocks. If you look at this here, this over here, from 10 o'clock on the 10th of August to 8 o'clock at the 11th of August, let's go with 4 hour, it should be an order block. Here you go. Here's order block. If you look at the daily should show an order block. No, not the daily, 4 hour. 4 hours should show an order block. So here's your order block. Okay, so this is the 11th of August. So maybe the daily has it as well. No, daily has it on the 10th of August, right? On the 11th of August, on the 4 hour chart, we have bullish order block. Okay, we have bullish order block, and it did what it did and went higher. It went higher. Okay, so when we look at now, quick recap, when we look at mitigation blocks, we know it serves as a continuation until price reaches a PD array. Okay, until price reaches a another PD array, and then we have a breaker block which serves as a point of reversal. Okay, and are the extreme to the start of a market maker buy on like yes, you are right. Yeah, so order block, like I said, order blocks are breakers, and therefore by extension the extremes of the breaker, the stop run, the extremes of it are essentially going into higher time frame breakers. Yes, right. So then when we look at liquidity voids, right? Now this you gotta give credit where credit is due. It's not ICTs, it is Chris Loris. Okay, it is Chris Loris. Sell side imbalance, buy side inefficiency is just a simple way of saying, okay, this is a bullish liquidity void, and this is a bearish liquidity void. It's a simple way of saying that. So that's ICTs, but the concept of liquidity void is from Chris Loris. Okay, so when we look at liquidity voids, right? The understanding of a liquidity void is basically telling you that okay, there is a lack of liquidity, obviously, but in terms of what? In terms of what? Right now, when we look at a bearish candle, a liquidity void as in terms of a bearish candle, we can see that okay, this means that there was sell side delivery, but there was no buy side delivery, right? There was no buy side delivery. So a liquidity void is an absence of one side of delivery. Okay, an absence of one side of delivery illustrated via a displacement in price. Okay, illustrated via a displacement in price. So when we have a bearish one, which ICT calls sell side imbalance, buy side inefficiency, the price was essentially, if you take it in terms of order placement, there was about, let's say, 10K. Oops. That was about 10K orders going down, right? And there was little to no buy orders left to get filled. Right? There was little to no buy orders left to get filled. Hence, price just boom, just dropped. Because to fill, right? To fill the 10K orders here, price needs to find liquidity in terms of counterparty, right? So the price needs to find counterparty liquidity. So where will price find this counterparty liquidity? At other PD areas. So where is the next level of liquidity? Here. It's unmitigated 4-hour order block, right? Which is why ICT says that price moves from PD area to PD area. Right? Price moves from PDA to PDA. That's simple stuff, right? So when we look at liquidity voids and fair value, you guys know what fair value gaps are, right? So when we look at liquidity voids and fair value gaps, right, they are best used in conjunction with these two and order blocks. Okay, liquidity voids and fair value gaps are best used in conjunction with mitigation blocks, breaker blocks, and order blocks. That is because if you don't have a fair value gap, or if you don't have a liquidity void, right? What that means is uh, that particular area of price, for instance, let's take a look at let's say this over here. You can see here this bearish candle in the middle. It was a liquidity void, yes, but you can see that this big wick over here, it offered an immediate rebalancing of price, right? It offered an immediate rebalancing of price, closing in this liquidity void. So if it closed in this liquidity void and tapped this bearish order block as well, right? Price would never stop here again. Okay, price would never stop here again because this portion of price has already been mitigated. So you would want to see a liquidity void or fair value gap with an order block, because what that means is it's not mitigated, right? It's not mitigated. So that's just how it is, and that's what I've seen from my studies as well. If you see a wick, like for instance, let's take for instance this fair value gap over here. If this candle over here had wicked inside here, right, and if price continues higher, it will not stop over here. Okay, it will not stop over here because orders have already been offered here. So if orders have already been offered over here, where is the next level of orders going to be? Up here, right? Up over there. So so if price is going to go up, what it will do is go up, consolidate higher, and then go lower. Okay, that's basically how I use liquidity voids and fair value gaps. I use it with that understanding, not because it's just a liquidity void, not because it's just a fair value gap, therefore it should do this, therefore it should do that. It's just that there is an order block, there is a liquidity void, there is a breaker block, there is a liquidity void. Therefore, in order to rebalance this for instance, in order to rebalance this liquidity void, right? Price needs to come back and then grab some orders, right? So where the order is going to be grabbed from? From the breaker. So the algorithm will reprice into the breaker and then continue its expansion to take out buy side liquidity. Why? Because the buy program triggered here, unmitigated 4-hour plus OB. The buy program triggered from this spot. Therefore, price is gonna the algorithm is gonna reprice into this breaker with the liquidity void, which made it super high probability, and price went higher. Now, things would be different if this wick over here, if it was a bit more lower like this. All right, if it was lower like this, then you can see that this portion here, all right, this portion here, what happened? It's already balanced, right? It's already mitigated. This entire portion over here has been mitigated. So where is the next portion of price that has not been mitigated? Here. So if yesterday's news event, if this portion was like this would have dropped down even deeper and then gone higher. Okay, I hope you get that. I hope you get that. If not, just let me know. Right, so can you explain the unmitigated OB and the ones? Okay, let me show you. Yeah, from here to here. This is what I mean by unmitigated, right here. And also took a low shot. It took a strong low, right? So strong low taken out. So price triggers a what? Low resistance liquidity run up. But we'll dig deep into that next week. So this is what I mean by unmitigated portion of an order block. Okay, is that cool? So then that is where price was working with it before it just jabbed one more time and then boom, goes up. Would I refine on the low time? No, I wouldn't refine it, because trying to catch the bottom and trying to catch the top, it's like you're playing a game with your mind. So you might as well wait till it gives you an entry and then wait. So that's why I have the bullish and bearish algorithmic model. So if I go here and if I go to the 5-minute, right, I have my entry already over here. So we have the stop hunt down, price breaks, right? Price breaks, and although it was ugly over here, I think on the 15-minute it was something that looked good. Yeah, the order block here. Now this order block, we would say that okay, price has already been balanced, but this is a reclaimed order block. Under the right circumstances, something that has been already mitigated can be mitigated again. Okay, so that is something I'll leave for Sunday. All right. So yeah. Okay, so that is basically it with regard to liquidity void, fair value gaps. Again, like I said, if this line or if this wick was just a bit lower, right, touching this high over here, then this reaction would not have happened over here. It would have happened much lower. For instance, somewhere over here, right? So that is what you should understand about liquidity voids, fair value gaps, and what them being mitigated means. Okay, what them being mitigated means. Because if you want to be precise, if you want to be precise and trade with tight stops, you should understand this. Because if you don't understand whether a certain portion has been mitigated or not, then it's like I placed my buy, my stop loss was this size, it took me out, and then it went up. Okay, it took me out, and then it went up. Then that becomes a case of you placing your order in an area that has been mitigated already, and it was predisposed to go lower to an unmitigated area and then go higher. Okay, so these are common mistakes. So if you can see over here, this dealing range high here, right? Yes, it reacted from the breaker because it is a reclaimed order block or a reclaimed breaker. Okay, it's a reclaimed breaker under the right circumstances, meaning you see price taking this high out, this high out. So these are what? Strong highs, right? This was strong, this was strong because they led to moves. Basically, they led to range expansions. So highs that led to range expansions are strong highs. Price takes out a strong high, takes out another strong high. Then what's the what do you call? What's the context? The context is okay. Now I need to see a low resistance liquidity run to the downside. How am I going to get that low resistance liquidity run to the downside? Because if price is pretty supposed to go up, it won't go up just like that. It needs to go up, come down, and then go up. So going up here into this breaker here means that it's reclaiming this breaker just to reprice lower into this breaker. Okay, it's reclaiming this breaker only to reprice lower into this breaker and then go higher.